Hi, my name's Casey Stubbs. This is going to be a beginner's tutorial on what is a covered call. You're going to understand exactly how this works. It's going to break it down for a complete beginner. There's no complicated jargon. I understand how it can feel to be a beginner, and I break down all of the terminology so that it doesn't matter who you are. You will be able to understand by the end of this video what a covered call is, why you would want to use it, and how you make that happen. So let's go ahead and get started. My name's Casey Stubbs, and what is a covered call? How regular investors can earn weekly income on stocks that they already own. So the first thing we're going to start is the beginner-friendly definition. A covered call is a trading strategy where you make money from stocks that you already own. And how do you do that? By renting them out for weekly or monthly income. We break it down and make it simple. You already own the stocks, and so now you can rent those out and make money on those stocks. Now, how does it work? Well, you sell a call option on a stock that you already own. It's usually 100 shares. So if you own 100 shares of any stock, you can sell a call on it and make money on the shares that you own. Now, what does it mean to sell a call? Well, let's go ahead. It means that it's a contract that gives someone else the right, but not the obligation, meaning they don't have to buy your stock at a specific price. And this is called the strike price before a certain date. And when you sell this call option, when you sell the option for them to buy it at a certain price, you get paid cash up front. The cash that you get paid is called a premium. And the reason I'm explaining that is because when you hear those definitions, a lot of times you don't know what they mean, but when you sell it, it's called a premium. So because you already own the stock, your position is covered, meaning there's not a big risk. You're just agreeing to sell it at a higher price if the buyer wants it. Usually they do want it, and usually if the price goes up, your stock will be called away. I'll get more on that later on, so keep watching. Why do people use covered calls? It's very simple. It's because you get paid up front. You actually get paid instantly. So as soon as you sell the call, you get paid. So if you own stocks, you can collect a weekly or monthly income. You get to keep that money that you get paid no matter what. And you can also possibly sell your stock at a profit. And you can do it again next week. So it's income coming in on a regular basis. Here's a little diagram that kind of explains how it works. What is a covered call? You own 100 shares, you sell one call option, and then you collect the premium. Very simple. That's Covered Calls 101, how to earn weekly income from stocks that you already own. I just thought I would visualize that so that you understand how it works. Now that you have the terminology, you can see it on a visual, it makes more sense. Let's go ahead and go further. Let's continue and explain what is a covered call. So this breaks down the strategy a little bit more. It's a strategy where you own shares, 100 shares of a stock, or it could even be an ETF like SPY or QQQ or something like that. And it's called covered because owning the share protects you if the stock price rises. Now let me show you visually what happens. If you sell your covered call, and this is the strike price, we'll assume that it's $150. You sell the call at $150. Now, if the stock goes below and stays below there before the expiration of the call, because every call has a very specific expiration date, usually it's daily, weekly, monthly. There's a lot of different expiration dates. But if it stays below that, what is the end result? You get to keep the shares and the premium. So really, nothing changed. You own those shares. You get money for those shares. It's that simple. Okay, now, if the price raises, we have that same strike price. Strike raises, well, now you get to keep the premium, just like over here, you get to keep the premium, but you do have to sell your stock for $150. And so that's actually not a bad thing, because if you bought the stock for $140 and your strike is $150, well, you just made $10 a share, which on 100 shares, that is $1,000, plus you get to keep your option premium. This is why people love covered calls so much and why they call it covered. All right, so here's a very quick example of how this works. You own 100 shares of Apple at $170. You sell a $175 call option and you collect $1.50 a share. That's $150. So you could actually collect $150 a week, and in some cases much, much more than that. Now, if Apple stays below 175, you keep your shares and you get to keep the $150 of premium. But if Apple rises above the shares sold and it goes above 175, you get to keep your premium, but you sell the shares for $170 a share. Now, remember, you might be wondering why people buy them. So this is the guy that bought your call, and I'm going to explain why he did that. Who's buying the call, and why would they do that? Call buyers are, number one, they're speculators that are betting on a rise. They're expecting the price to go up. And so they're seeking leverage, less capital and higher upside, and they're hedging other positions. So you get paid because they want the upside. So let me explain what that means actually. It means that they can buy your call for $150 and then they can turn around and sell that same call for $250 without actually having to buy the shares. If they had to buy the shares, they would have to spend a lot more money. Right? On $150 stock, they're spending $15,000, and here they can buy that much shares and get a massive amount of profit just by buying and selling your call. Right? So you're providing the leverage for them to make money on the call so that they can profit and make money on upside movement without having to put a lot of capital at risk. So that's why you can do this. It's for the speculators. Why would you use them? Well, it's pretty simple and straightforward. You earn income from stocks that you already own. It's lower risk and it has slightly with a premium cushion. So it's repeatable and it's beginner friendly. You can do this over and over again. And a lot of people they just want to own stocks all the time. And that's awesome. That's how I got started. That's what I recommend is you just keep buying stocks. But why not collect money on stocks that you absolutely love? But there is a risk involved, right? There's a risk involved. And so what is the risk? Well, if the stock drops, you still own the shares, but your premium cushions fall. Well, what does that mean? That means the further you go down, the less amount of premium you're going to be able to collect. So if the stock goes down and down and down and it's a really bad run, well, your income's going to decrease quite a bit. And so you got to remember that. And again, if your stock rises too much, your gain is capped at the strike price plus the premium. So if you sell your stock, you sell your call at $150 and the price goes up to $200, you can only sell it for $150 because that's where you sold your call. So the risk is it does put a cap on your profit if you have a parabolic run on your stock. With that being said, those are two risks. This is why I love it, because we can collect income on stock that we actually want to own. If there's a weekly income formula, you get paid, you own it. The calendar, you do this every week. That's how it works. Let's take a look at how this will work. We can own 100 shares, we sell a call option weekly, we collect premium, and we repeat. And what I like to do, my goal is to do this every single week and try to earn 1% a week. That is what a covered call is, and that is what the strategy is. While that's the basics, I hope you really understand and have any questions. What I do is I teach people how to replace their income, and they create consistent cash flow from stocks that they already own. And I have additional strategies that I'm going to teach. So if I get a lot of feedback, comments, likes, shares, views, I will create some additional content regarding this. But let's get working on this. Let me help you replace your paycheck with options. Some next steps you can take. If you want to get your own personalized roadmap, you check the link in the description. I also do a weekly live training. You can check that out. And you could follow me for daily trade alerts. All of those links are in the description of this video. Thank you so much for watching. Please ask a question in the comments because I answer every single question. And I hope that this has been helpful. And if I get more feedback, I'm going to do more covered call strategies, like how it actually works. This is just for beginners, not on how to actually trade it, but to understand what it is. If this is popular, I will show you how to do it in a later video. Thank you.